Well, wasn't that a party? The S&P is now sitting something like 2% below an all-time high. Another 2% up. And we start printing all-time highs. Some stocks are hitting their all-time highs now. Apple, all-time high. Anyways, this was a very dovish very dovish FOMC meeting, and even the press conference was shorter. I don't know if you are picking up on that, but each press conference is almost 5-6 minutes shorter than the one before. This has been the shortest one in a long time. Coming in after the opening statement, coming in at somewhere just a little over 30 minutes, not an hour like it used to be. So the pressers are getting shorter, and the Fed pretty much has signaled in this one, yeah, we are done. We are done. And Powell's demeanor at the last press conference, coming out really relaxed, sort of gave me the indication that this is a guy that's done, and he confirmed it this time. The big thing that changed in the statement here is instead of further, it is any on additional policy firming. Committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer term. In support of these goals, the committee decided to maintain the target range for the Fed funds rate at 5.25% to 5.5%. The committee will continue to assess additional information and its implications for monetary policy. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, and blah blah blah. Pretty much the same as the last ones. It's the change from further to any. Let's have a look at the dot plot. That is not the dot plot, but the summary of economic projections. And let me just make this a little bit larger here so we can see it. So look at change in real GDP versus September for 2023, upgraded from 2.1 to 2.6. Unemployment staying the same, but look at inflation from September to now, dropping from 3.3 to 2.8. So stronger growth, no change in unemployment, but you are seeing inflation coming down. And September projection for core PCE 3.7 down to 3.2. So the core and headline coming down while growth is stronger. But look at what happens in 2024. In September it was 1.5. It's now dropped to 1.4. The unemployment rate unchanged, expected to be at 4.1 by the end of the year, and inflation coming down to 2.4% by the end of 2024. Same with core PCE, that's a big drop, 3.2 down to 2.4. It was 2.6 down to 2.4. The more interesting thing is the Fed funds rate. End of 2023, 5.4 was 5.6, indicating in September that somebody somewhere saw one more rate hike. No rate hikes here. End of 2024 was 5.1, indicating roughly 2 rate cuts, down to 4.6. Basically 4 rate cuts over 2024. The market was 4 to 5 rate cuts over that period of time. So lower path of the Fed funds rate. Still believe the neutral rate is 2.5%. Pretty dovish. Pretty strong on growth, and pretty dovish in terms of where they see rates going. Let's look at the press conference, because a lot of dovish things were said there. Opening remarks started pretty much right away, squarely focused on our dual mandate. Previous, we're squarely focused on inflation, and now we're squarely focused on our dual mandate. Inflation has eased without significant increase in unemployment. The policy rate is, and these are his words, well into restrictive territory. The full effect is not yet felt. We believe we are at or near the peak for this tightening cycle. I don't think that the or near is really meant. He said we are at or near, and I think you got to put that in for the market. We are at the peak for this tightening cycle, well into restrictive territory. Questions, Associated Press. What interpretation should we put on the word any? that is in the statement of any further tightening? And the answer, straightforward, it's an acknowledgement that we are likely at or near the peak of rates for this cycle. CNBC. Waller suggests targeting real rates. That's not really the question. I'm just trying to shorten it, but the question was along the lines of Waller suggests that cuts to the target rate would be appropriate so that real rates don't get too restrictive. What's your comment on that? He says, we're seeing what we want to see, but we're not there yet. When we do start to cut, when we do start to cut, or the question of when we start to cut, was a discussion at our meeting today. And when he said that, I thought it was a discussion. So there was a follow-up, which there should be. What was the nature of that discussion? Members wrote down their policy projections and stated them without discussion, but a general consensus. It will be a topic of discussion at future meetings. It's a general consensus that rate cuts will be a discussion at future meetings. Washington Post. Has the economy avoided a recession? Answer, little basis for thinking the economy is in a recession now, and he stressed the now. But the question was more broadly, have we avoided a recession? So he's saying, well, we're not there now, and there is always a probability of a recession at any time. Empirically, it's 25-30%. So at this point in time, what's the probability? Well, the empirical probability. That's it. In what ways has the economy surprised you this year? And his answer was, listen, it surprised all forecasters. And I sort of agree with that wholeheartedly. Reuters, what motivates the lower rates next year in the SEP, going from 2 to 4 rate cuts? What motivates that for next year? And the answer is versus the September SEP, expectations for inflations have come down significantly. Follow-up question, the election cycle has anything to do with it? Because if you can cut rates at the beginning of the year to improve the economy, it stands in Biden's favor, right? Nope. We will do what we think is right for the economy at the right time. He poo-pooed that one very quickly. Wall Street Journal, market is already cutting for you. He started off by saying, in the beginning the market was raising rates for you, and you said, that was sort of a welcome thing. The market is already cutting for you, anticipating a full point by Q3. Are you comfortable with that? And his answer was, we will focus on what we have to, and people have their own views. He's used more words, but I'm trying to keep it short. A follow-up, market seems to believe inflation is coming down credibly. Do you agree that inflation is coming down credibly? I welcome the progress. We need to see more. New York Times, in the SEP, we note growth for 2024 is less than potential. If growth is greater in 2024 than the 1.4, is it still possible to cut rates in 2024? Is above trend growth itself a problem? The answer is we look at the totality of the data. It's only a problem if it affects our work towards getting inflation to target. Axios talked about the labor market. What do you need to see to conclude it is in balance? Because he noted, you say that it's coming more into balance. What do you need to see to conclude that it is, in fact, in balance? Lower job growth, lower wage growth, running around 4% is a bit above the target. So I think he's probably thinking 3.5% wage growth or lower is something he needs to see, and lower job growth in terms of the non-farm payrolls that are added each month. But he concluded development has been positive. Financial Times, general population has more economic sentiment than the soft landing narrative. What explains this? And I thought it was a pretty good answer. He says, yeah, inflation is coming down, but inflation is coming down. It's still inflation. The price level's still going up. So you have inflation, which is high, and if inflation starts dropping, the growth rate starts dropping, the price level is still going up. Even though inflation is dropping, the rate at which prices are increasing are dropping. If you recall a press conference Biden had about 2 weeks ago, he said, inflation is coming down and we're not seeing companies lower their prices. So we're wagging our finger at you companies. You better start lowering your prices. And it's like, Biden, dude, do you not understand? Inflation still means prices are going up. They're just going up at a lower rate. I don't think he understands that. This is our elected officials, a general lack of understanding of even the most basic concepts of the economy, and yet we allow them to make decisions about it. I don't understand that. Politico, if the economy falls apart, they didn't say fall apart, but gave a bunch of if labor did this and this did that and this did that. In other words, just shorten it. If the economy falls apart, will you consider job done on the demand side for demand wise? Would you consider it done? It's not what we're hoping to see. Of course not, right? We will look at the totality of the data. He's not really committing himself to saying, if you see this one thing, will you do something? If you see that one thing, will you do something? It's like, look, we're just going to look at the totality of everything and not just one thing. So if, unemployment begins to rise, if, the market is weak, these sorts of things, we'll consider it, but we're going to look at everything. Next question was Bloomberg, Mike McKee. How will you ensure you are not behind the curve in cutting rates? Which I think was a good question. And dovish answer, we are aware of the risk that we would hang on too long. So they're having that conversation. Very focused on not making that mistake. Our dual mandates right now are in balance. So they are aware that they may run the risk of hanging on too long before cutting rates. They are having that conversation. Follow-up, cutting rates, will it be tied to some measure of progress, or will it just be ad hoc each meeting? And the answer is we're just at the beginning of that discussion, so we don't have anything to say on that. Fox Business really tried to get Powell to talk about the economy and maybe say that the reason for the rate cuts next year is because they see a weak economy, so that they could go on to Fox News and say Biden's economy sucks. The cuts in the SEP, belief that Biden's economy sucks? No, but he didn't say that belief that Biden's economy sucks, but he was asking the question in such a way to try to get an answer that yes, we are concerned about the softness in the economy, so that they could say even the Fed thinks Biden is doing it. You know how they do that, right? Follow up, how sticky is core inflation right now? Another dovish answer, we are seeing progress in all three categories of core. In goods, in housing, and in services ex housing. They were pointing to this one being the weak, the really sticky one, and say we're now seeing progress in all three categories. And I had one eye on TLT the whole time, and it really didn't give up anything. I mean, it just kept going up, and even after hours, looking at the futures, it's up again. So throughout this whole meeting, there was almost no volatility in the sentiment. After the fact, it was just, he basically supported everything the market was doing. Bloomberg, another Bloomberg, not Mike McKee. How does the CPI and PPI that you got Tuesday and Wednesday add to the discussion? It came out Tuesday, Wednesday, maybe a little late, but now that you know it, how does it add to the discussion? And he said some incorporated it into their SEP forecasts. It's not that it was too late. Some did incorporate it into their forecasts. Now, follow-up rate cuts. Any structural shifts in the economy to think about in terms of rate cuts, and I think this is the right answer for that. Is where is the new neutral rate? Is there even a new neutral rate? And if there is, where is it? Next question was from Yahoo Finance, and I heard that. I said, well, really? I mean, this still exists. It still exists to the point where you actually have somebody on payroll at the FOMC asking questions. This is interesting. I didn't think it still existed. How much closer to 2% for inflation? How much closer to 2% before you consider cutting rates? And his answer, he said, we will move well before 2%, and then he sort of backtracked on the well before, but too late. He said it, I heard it, we will move well before 2% so we don't overshoot. Can't give you a precise answer. The follow-up is, so below 3%, would inflation being below 3% do it? And he says, I don't want to give a number. Yahoo Finance. Market news. Inflation has come down quickly. Is there something different about the U.S. economy? Is our understanding of inflation changed? And his answer was, this inflation was not classic demand driven. It was supply and labor driven. The typical type of inflation that's well understood is demand driven inflation. Higher rates do work on demand driven inflation, but I've said this way at the beginning of the hiking cycle that if you have a significant amount of this inflation that's supply induced, higher rates will not fix it. Only improved supply channels will fix it. Higher rates may only make it worse, as it did in housing. Barron's, the balance sheet, any considerations of altering the pace of QT? He said no, but he did give quite a good answer here. He says, we're seeing the reverse repo drop and reserves are holding steady at about $3.5 trillion. Reserves will begin to decline when the reverse repo levels out. And for that statement, they're looking to hold at a level somewhat above ample reserves, but didn't give a number on what ample reserves were. So we know it's somewhat less than 3.5 trillion. So we have to first see the reverse repo level out. It's still dropping. It's still quite high, but it down from 2.4 trillion to something like 800 billion. Once we see that drop down to a point where it levels out, then reserves will start dropping, and they'll stop the balance sheet runoff when reserves are at a level somewhat above ample reserves, although we don't know what that level is. Then they will slow or stop balance sheet decline. We are not at those levels yet. And that was it. When they said we're going to take the next question, the next question will be the last question. It was only like 3:13. I thought that's really early. All of a sudden, we haven't even heard from some of the regulars that show up there. Where we have questions from all the NPR. I did not get to ignore NPR's question this time around. I don't know if you picked up on that. Powell ignored NPR altogether himself. I didn't have to bother ignoring their question, but that was it. So the interesting question, I think, will be for the next press conference: does it get another 3 or 4 minutes shorter? Because it has been getting shorter each time. This is the shortest one I've seen yet in like well over a year and a half now. Does the next one get shorter? Are they signaling something about the nature of the press conference? Because there is some discussion that maybe they're just too accessible. Maybe they need to be more like Greenspan, where he just didn't say anything. Maybe they're just too accessible, and they end up being a victim to things that they say, so that they have to watch what they say, so the market doesn't overreact or move too quickly in one direction. That maybe they're thinking that, maybe we don't really need these press conferences going forward. They were started by Bernanke during 2008, 2009 to give the market some more clarity and visibility into the decisions that were being made, because they saw the market as a tool that they could use based on what they would say, that they could create sentiment based on what they were saying. Well, and they continued on since then. It's really a recent thing. Recent meaning, it wasn't 30, 40 years ago that this was happening. You just didn't know until a decision was made. And they're cutting back the length of this. Is this sort of a hidden signal that no one's picked up on yet, that maybe at some point they will just go from a press conference every meeting to a press conference only when there's an SCP, and maybe a press conference once a quarter, and then maybe just cancel it? Are they heading towards that? If the next press conference ends at, this one ended at 3:13 was the last question, basically. If the next one ends at like 3:06, I gotta say, I think they're moving towards just saying, look, let's just not do it at all. Anyways, that's what happened today, and you saw the result. TLT sitting at I think $97. I was contemplating selling some $100 calls, but I thought, nah, I'll wait another day. Let's give it another day. TLT's come a long way, and with the market 2% below an all-time high, and pretty much every risk event behind us, we're really not going to see any significant data till the last week of December. There's no earnings. There is no more Fed this month. There's no inflation data except PCE, but PCE usually follows very closely with CPI. We don't get jobs till January. There's really nothing between here and the end of the year. So if you're thinking, wow, maybe I'll take a short on the market, I wouldn't do it now because there is no catalyst, no negative catalyst that could potentially derail this into the end of the year. So, let's see where we go. But I certainly wouldn't be shorting anything at this point.